Before we begin, just a quick note. This podcast is produced by qualified financial professionals and is intended to share general information and insights to help expats better understand common financial topics. However, everyone's circumstances are different and regulations can vary by country, so nothing discussed should be taken as personal financial, tax, or investment advice. If you're considering making financial decisions based on anything covered in this episode, we recommend seeking professional advice tailored to your individual situation.
Hello and welcome back to another episode of Expert Money Matters. I'm your host Georgina, and today we are setting our sights on the sunny shores of Portugal. It is consistently voted one of the best places in the world to retire or relocate, but the difference between a dream life and a financial headache often comes down to planning. We are going to cover everything today, from why your UK ISA might be a problem to estate planning and even the nitty-gritty of the visa process. To guide us through this, I'm delighted to be joined by the Group CEO of Chase Buchanan, Lee Eldridge. Lee, welcome to the show. Before we get into the complexities of cross-border finance, could you introduce yourself and tell us a little bit about your role at Chase Buchanan?
I am the Group CEO of Chase Buchanan Private Wealth Management. My daily responsibilities are running the group, which covers all of our offices across the US, Canada, Middle East, and all of Europe, including Portugal.
Great to have you with us. Now let's start at the very beginning of the move. A lot of British expats assume they can just keep their financial life exactly as it was when they hop on the plane. Is that the case, or do things change once you become a Portuguese resident?
When moving to Portugal, it is imperative that you consider how your investments will work when in Portugal. For example, a UK resident can have a ISA, which is a tax-free box, and effectively the assets grow free of tax inside. When you move to another country like Portugal, the tax regime is different. Okay, so if you have UK assets, it is important that they are housed in a certain way or structured in a certain way to make them applicable to the Portuguese tax rules. Otherwise, you leave yourself exposed to unnecessary taxation. The same applies to pensions as well. A UK SIP, which is a self-invested personal pension plan, has all the tax benefits in the UK. However, when you move to Portugal, there are various different options available to you.
So the famous tax-free wrapper of an ISA suddenly isn't so tax-free. That leads to the question about who gives you advice. Many listeners will have a trusted financial advisor in the UK they have used for years. Can they just keep using them post-Brexit?
It's, again, very important to make sure that you have the correct advice from a highly regulated advisory firm. Since Brexit, a UK-cited advisory firm can no longer advise you overseas because of the lack of something called passporting, which used to be there. Passporting works in a way that if you are a UK firm, you can notify another country in Europe, like Portugal, that your firm wants to advise clients in Portugal. Since Brexit, those agreements have all fallen away. At Chase Buchanan, what we did is we have taken up a European regulation, so it enables us to still be able to help our international clients.
That is a massive shift that I think catches a lot of people out. The passporting rights are gone. So if people need to find a new advisor who can operate in Europe, what should they be looking for in terms of qualifications? Are their standards the same across the board?
Investment strategies as themselves don't really differ that much. All advisory firms, wealth management firms, banks, institutions have a process that they will follow, which will ascertain a client's risk. They will have a way of looking at market data and then actually building out portfolios in line with your attitude to risk. So fundamentally, that element stays the same. What does change is what type of underlying investments you have. For example, some investments will be interest bearing or dividend bearing, which means that they grow and they will either pay you interest like cash on a bank account, If you hold stocks and shares, they typically will pay a dividend. Now, in the UK, dividends and interest on cash is taxed differently to that of Portugal. So what we do is we always make sure that investors are having a full review just to make sure that the portfolio and what assets are held are in line with Portugal rather than that of the UK.
It's really reassuring to know that those standards do exist. You mentioned earlier that investment structures might need to change, but what about the strategy itself? Does a Portuguese portfolio look drastically different from a UK portfolio?
Different jurisdictions, when it comes to financial advice, have different regulators. What that means is that different regulators will expect a level of financial acumen, a level of qualifications. Within Chase Buchanan, the advisors are either a minimum of level 4, which is a UK standard or beyond, or they will be working towards that and simultaneously will have other qualifications that mirror or match the level 4 qualification. In some arenas, because there aren't a regulator, then it is possible that somebody could give advice without, the level of qualifications required under UK standards. But it all depends on which jurisdiction you operate in. What we do with Chase Buchanan, be it Chase Buchanan USA, Chase Buchanan Europe, for example, in America, all the American business and the clients that we have, all of the advisory team are minimum of Series 65 qualified. In the UK and obviously across Europe and the Middle East and Canada, all the advisors are either level 4 UK standard or they have the equivalent for the country that they work in.
Okay, so the strategy stays similar, but the tax treatment changes. That sounds like a complicated transition. How do you actually help a client bridge that gap between the two tax systems without getting hit by penalties in both countries?
It's an interesting journey because you're going from one country with one tax jurisdiction to another, i.e. the UK and Portugal. What we do to bridge that gap is we have a specialist tax team that can give cross-border tax advice. So what we do is we make sure that as an investor, you're structured in the correct way from a taxational issue. What I mean by that is that things like ISAs, pensions, different types of pensions are taxed one way in the UK, but in Portugal they are viewed differently. So what we do is we start the process by bringing in the tax team to give the tax advice. Then we do is we look at the investments to make sure they're all structured efficiently in order to help you when you're in Portugal.
Lee, you mentioned double taxation there. That is a phrase that strikes fear into the heart of every expat. Can you explain simply how these treaties work so people don't end up paying the taxman twice?
So DTAs, which is double taxation treaties, are between different countries. What that does is it means, for example, if you're in the UK, you move into Portugal, you won't be taxed twice. Okay, so for example, if you're in the UK, move to Portugal, if you've got a tax exposure or an investment that's held in the UK and you're now a tax resident in Portugal, you won't be liable for the tax that you have in the UK. So you pay tax in Portugal. If you're in a jurisdiction where you are due to pay tax and there's a higher, say for example, you've paid tax on maybe pension income in the UK, but that's also liable for pension income in Portugal, the DTA exists to mean that you won't be paying both sets of taxes. What you will have to do though, for example, if you pay in the UK and it's a lower rate of tax and then you're in Portugal and it just happens to be a slightly higher rate of tax, what you would have to do is then pay the difference, obviously, to Portugal, and the two countries then have the agreements to sort it out with themselves.
That's a relief. Now, another risk that people often overlook is currency. If your pension is in sterling, but your coffee and groceries in euros, you are at the mercy of the exchange rate. How do you manage that volatility?
When you talk about the risk, most people think about how much they're going to lose, and that's not the case. What you have with currencies, you think about it this way. In the UK, your base currency, and what I mean by base currency is what your assets are held in, is sterling. When you're in Portugal, your base currency will become euros, purely because you've got different countries with different currencies. Different ways to minimize that is what we do is we design portfolios. We can have a hybrid within a portfolio. So you would have an element of it invested in pounds, some of it invested in euros. You can draw your income that way. That's one way to deal with it. If we're looking to move money for clients, what we do is we use specialist FX companies. A lot of people will go to the banks, and the banks will make something called a spread on the transaction. A spread is a margin that they build in. It's what they can actually make on the transaction and what they give you on the exchange rate. So if you go to the high street banks, it's not that beneficial and not that competitive. So we use specialist firms in order to make sure you get an enhanced rate that benefits you.
For this part of the discussion, we have to talk about the long term. It's not the most cheerful topic, but estate planning is obviously vital. How does inheritance tax work when you have assets in the UK, but you are living in Portugal?
A lot of people get very excited. You know, they're moving to Portugal. It's sunshine. It's a whole new experience. It's kind of like having a second life, I guess, in some ways, because the children have grown up now and you have this bit more freedom. They've got all their money sorted. The portfolios are running well. One key element is estate planning, because it's the next generation. What happens to your money when the eventual day comes for yourselves? You know, and so what we do at Chase Buchanan, we have a tax team, a specialist team of tax advisors that are there to look at your overall position and how we can help you to minimize the estate plan, like the inheritance tax element of your estate when you pass. It's not always impossible to minimize all of your inheritance tax liability, because there are things like domicile. So just because somebody moves from the UK, it doesn't mean that the HMRC do not sort of have a track on you. You have to be out of the UK for a long time in order to be able to remove domicile. What does domicile mean? Deemed domicile basically means that even on passing, so in your eventual last days on this planet, HMRC in the UK can still look at your estate and still tax it in the UK. There are different ways to minimise it as well. We're using additional life assurance to cover any liabilities you have, or trusts and these complex matters, because when you've got cross-border, and we have a lot of clients that have assets in multiple countries, you know, not just one, not just two. We have some clients that have assets in over 10 different countries. So what we have to always make sure is that the estate planning is done in a certain way, in a very controlled manner. One thing that people should always do as well is they should also, in my opinion, make sure that they have a will in the UK, but also have a will that is in Portugal. Now, within that as well, you are able to actually express in both wills which one will take the precedent over the other. And that's another important piece you should always put in the will.
That is such a critical point, making sure your will's aligned so your legacy is protected. So we've covered the structural foundations, your advisor, your currency and your estate. But now let's get down to the bills you actually pay while you are alive. A lot of people assume that if they sell their home in the UK to move to Portugal, it's a simple tax swap. But is the tax landscape actually that similar regarding capital gains?
There are many different taxes to consider. Like the UK, if you have your main residence and you sell that property and it's at a gain, you won't pay capital gains tax. Portugal, kind of similar in the sense that if you sell a property in Portugal and you made a gain on that property sale, as long as you reinvest that money back into a property within the EU, they will not tax you in Portugal. Another type of taxation in Portugal, like most places, is income tax. There is the opportunity to use something called the 85-15 rule. The 85-15 rule is designed that you only end up paying 15% on your tax liability.
That 15% rule sounds very attractive compared to some other European jurisdictions. But obviously expats aren't just bringing property proceeds, they are bringing savings and investment portfolios. How do you structure that capital efficiently? Is there a specific vehicle that works best for long-term residents in Portugal?
When you move to Portugal, one of the structures that you can house your money and run your portfolio is through something called an international bond. That's an account typically held in somewhere like Luxembourg, for example, Ireland, different jurisdictions. When you establish these, you can have them as a UK tax resident, but the taxation is very different. So in Portugal, there is a sliding scale, and if you hold the policy for 0 to 5 years, then your exposure to tax on your gains is 28%. The next sliding scale is between 5 years and 8, and the rate of taxation then drops to 22.4. The next scale that we have is 8 years plus of holding your account or your policy. The taxation drops down to 11.2%.
So patience really pays off there. Dropping from 28% down to nearly 11% is significant. I know a lot of British expats might already have investments in places like Jersey or the Isle of Man. Is it safe to just leave those as they are, or does Portugal view those traditional offshore centres differently?
One of the downsides of not being tax compliant for Portugal with your investments is the difference in taxation levels. So, for example, if you have an investment that's held in the UK and is growing on an investment platform, when you come to make your withdrawals from that investment, your withdrawals will be taxed at 28%. If the asset is listed in what Portugal deems as a blacklisted country, and a blacklisted country can be Jersey, the Isle of Man, these kind of jurisdictions, then the taxation rate goes from 28 to 35% on the withdrawal that you take. There's another element to this as well. That is, if you have a trust and you draw money out of a trust and the underlying investments are on a blacklisted jurisdiction, you're actually charged 35% on the whole of the withdrawal, not just your gain.
Wow, 35% on the whole withdrawal. That is a massive trap for the unwary. Let's shift gears though from portfolios to bricks and mortar. We hear a lot about the golden visa driving up prices. For someone looking to buy now, is there still value to be found in the Portuguese property market?
Well, I think it's important to look at value for money as well, because there has been a large increase in valuations over the years, given that the Portuguese government had something called NHR, the Non-Habitual Tax Residency, which was very beneficial for people moving to Portugal. If you look, for example, around the Varo area, Almansil, that sort of area, because it's had a large influx, the property prices have been increasing. However, my personal preference is you can even drive 35, 45 minutes around the coast up towards Lagos, for example, that, in my opinion, it's a bit more authentic Portugal, and the property prices are slightly more beneficial to the buyers. As always, there's many things to consider when buying a property. One cost you do have in Portugal is something called IMI, which for English, the typical English expat is similar to council tax in the UK. And that's charged at 0.8%, for example, in the Faro region, 0.8% of the value of the property up to 800,000, and then you have an additional IMI. Now, what's important to note is that all the different regions in Portugal have different percentages for IMI.
That is really great advice. Looking for that authentic Portugal can save you money up front and on the ongoing taxes. But before anyone can buy that dream home in Lisbon, they need to actually get into the country. The D7 visa is the most common route now. Practically speaking, how difficult is that application process?
The process isn't too challenging. What is challenging is gathering all the right paperwork in order to go for your appointment for the visa. There are visa companies that specialise in the application of visas, and they accept them. Places in London and Manchester, for example. If we take the D7 visa, which is the long stay passive income visa, which allows you to take up a visa to stay in Portugal, you have to be able to demonstrate certain income, i.e. passive income from pensions and that sort of thing. There is a checklist that you can have. For example, you will need, for example, the last 3 months' bank statements from the UK. You will need a Portuguese bank statement as well, so you will need an account in your name in Portugal. What they also want to see is that you have the equivalent money in there to the minimum wage for 1 year in Portugal. So if you, for example, put 10,000 euros into the bank account, that will be more than sufficient to cover you for the application process. You also have to obtain a criminal check for the UK, so that can be done online. It then comes to you in the post. Now, one of the important things to remember is it has to be apostilled, which how you obtain this is you go to a notary, which is near, there's normally one near where you live in the UK, and it has to be a notary that can also do the apostille, and the apostille then has to go off and it gets signed off by The Hague and it comes back with a seal stamped on it. That process can take 2 or 3 weeks. If you go for your visa application and appointment and you do not have it apostilled, they will reject you there and then, so you then have to go off and then rebook and start the process again. If you've got a company in the UK, they want to see things like the certificate of incorporation. They want you to be able to show a bank statement or a tax return that also shows dividends if you own a company. So there's a whole checklist, but that's just some of the ones that are very important for you to recognise or to understand you will need when you go for your visa.
That apostille stamp seems to be the stumbling block for so many people. So let's say we've got the criminal record check stamped, the bank account funded, and we go to the appointment. What happens next? Do they take your passport away? And when do you actually become a resident?
So once your visa application has been submitted, what then happens is if you've handed in your passport, because what's important as well is that you have to hand your passport in when you actually submit your application form. It is possible to retain your passport. You just have to submit a letter to explain that under the Schengen travel rules that you're able to travel, you would like to retain your passport. When you do that, they will ask for a copy of your next flight within the next few months, because they want to make sure if they give you the passport back, there's a valid reason for doing so. Once you've had confirmation that your visa has been processed, the application, you will be contacted by the Border and Immigration Office in Portugal, and you will have to go and meet them to get your visa stamped in your passport. So once you've then gone through the process of the visa application and you've had your meeting and got your visa put into your passport, at that stage you're then legally allowed to register as a resident of Portugal.
It really sounds like a process where detail is everything. From getting that Hague apostille stamp on your documents to ensuring your wills are synchronised across borders. Lee, thank you so much for that incredibly detailed breakdown. It's clear that while the Portuguese dream is very much alive, you need to go in with your eyes wide open regarding the paperwork and the tax planning. For our listeners, whether you are just starting to look at property in the Algarve or you are already packing boxes, do not guess with your finances. Get professional cross-border advice. I'm Georgina, and this has been Expert Money Matters.